Hey everybody, my name is David Choi, this is Conor Moore, and today we'll be talking about building up the economic foundations of the metaverse using existing tools that are in the market today. As you saw, like NFT Bank and as well as NFTFi are already building up the primitives, and we want to be the layer kind of on top of it, where we stand behind the markets and try to scale, well, the liquidity markets behind it. And this background is actually kind of inspired by like this Hamiltonian idea of building up a national bank in order to facilitate liquidity and to ensure that they will have, well, money next time something goes wrong. So in terms of this founding father moment, in the same light, if you believe that the metaverse will be fueled and financed by trade, then trade, among other things, is dependent on the willingness of others to lend you money and develop credit. And credit is what builds nations. And that's kind of how we're thinking about building up the credit markets. It's more like national lending than it is corporate lending or individual lending. And the first form of any form of debt in any economy is going to be secured debt, which is collateralized loans backed by something that's real and material in order to develop your credit worthiness. Then you can see like advanced forms of credit being developed. And also, in terms of the fourth form of debt, which is collateralized debt, it will also be connected to the first form of utility and assets within the metaverse. And that's kind of what NFTs represent. And that's what we'll be jumping into in terms of like a two-section presentation. So a little bit about MetaStreet. MetaStreet is an interest rate protocol for the metaverse. So we sit behind these protocols and we facilitate the lending, and I'll get into details later. But our goal is that by controlling the interest rates, which is timely with today because today's the FOMC meeting, which I'm not sure how many of you guys know about that, but that's the interest rate meeting of the United States, and interest rates eventually control, well, everything. So, and I'll get that in a minute, but as we all know, if you lower interest rates, things usually grow. But by facilitating the controls of these mechanisms back to the hands of the users, well, you can actually control what your own metaverse will become and what will grow into. And our first product focuses on NFT debt capital markets. Now, what does that mean? It's kind of a loaded word, and unless you work in finance, it's kind of confusing. So we divide it, we're going to talk about two parts effectively about NFT debt and capital markets. So I'll be talking about NFT debt, Conor will talk about capital markets. And what does this really mean, like NFT debt capital markets? Well, NFT debt's a mortgage. That's a very simple description, where when you're getting a house, obviously the house has a deed is the house, you get money for it. And then capital markets is a little more complicated. There's an old man phrase whenever somebody says, like, in this economy, you can add that to anything. You're getting a mortgage. In this economy, a sandwich. In this, it's like kind of explaining how much money really is there at a marginal level, but also how much money is in the entire markets for you to facilitate, well, transactions, volume, credit, and everything, well, that sits in the metaverse, the virtual world that we're creating today. And going with the founding father idea, what is the assets of the metaverse? What are the assets that are sitting? And we've talked about it quite a bit, but we organize it in kind of like a more digestible way. It's very similar to what you see before. It's like least liquid to most liquid. And my first job was actually doing art lending. So I used to collateralize Warhols, Frank Stellas, Richters, and stuff like that back in 2014 to provide loans. But it's one of the most illiquid markets in the world because, well, there's Sotheby's and Christie's, which happens in November, and that's like the main auctions, but it's a very illiquid market. But at the same time, it's really valuable, and there still is a lot of loans in that market, about 10 to 30% securitization, but the LTVs are loan to value is very, very low because it doesn't trade very often. So, but what does it really represent? Why were artworks kind of the first big use case for NFTs? And my theory is that NFTs combine two main technologies, which is a double spending problem, which is ownership of provenance in your history, which also happens to be the #1 value driver of artworks, as well as labor value. It's like it's provenance. It's connected to the artist. You actually feel and own the underlying asset. So art, collectibles, equipment like tractors and buildings, they're the best comparables to extremely illiquid, labor value connected assets. And that's kind of what the least liquid things represent. They're true demonstrations of the utility underneath the assets that you have. It's kind of why people are like, don't financialize NFTs because it's for culture. Well, that's true. And the real estate's right next to it. It's also liquid. It's also the second largest asset after avatars and PFPs and the existing NFT markets today. But this also is actually where Conor and I met at Deutsche, where we're scaling the real estate markets and the debt that goes behind them. They're also very low mark to market because they're connected to real things that we use every single day as humans. We're living in them. It's space, it's ownership, it's the physical assets. It's one of the four factors of production within the metaverse, or also the real world. Then there's also commodities, which are connected to end user, but all of these things are physical hard assets, which we find most comparable to the NFT assets that we see today. And this left-hand side would kind of separate from the next two, which is stocks and bonds and currencies, because the right-hand side really represents things that are artificially created to facilitate liquidity, whereas everything on the right-hand side is everything that we use every single day that we're connected to. That's why artwork is artwork, and it's not, well, a bond. It's not currencies. And we can try connecting the two, but in reality, it's things that are used materially, and that could be from cars to equipment to land to axes to anything that you have. And it's also why it's really hard to fungify non-fungible things versus things that are incredibly fungible, because they were made for fungibility. And this directly affects how you collateralize them and how loan works behind it. And these are really low mark to markets, like they don't trade very often, but there's a lot of value locked up. And the reason why I bring this up is because, like I said, it's connected to this labor markets that's being invented at the same time. Because if you look at the four factors of production, which is land, labor, entrepreneurship, and currencies, we've just invented the right two, which is labor and NFTs. And these are two missing elements to create a proto-nation, which is what we're seeing in the metaverse, a virtual world being built, an entire economy is being created. And how do you control economies? Well, if you're Christine Lagarde, you just lower interest rates on the debt you issue. And that's how you control no more Weimar republics. But yeah, and so the four-factor production, we're seeing like NFTs really being built, games, which are quests, but really is labor. And the others are already being invented in the periphery. But all of this is coming together to try to create the economy. And I'm not sure if any of you guys played like video games, but a lot of people don't play games because it's fun. They do it to win and to make money in video game currencies, like myself. And this comes back to like, are NFTs really fungible? We can try, but they're really not. They're genuinely different things. They're hard assets. But what is fungible? And we believe their derivatives are fungible, which is the loans that they represent. The moment you securitize a single asset, well, that's why you have like mortgage-backed securities. There's a bunch of mortgages. You don't have a bunch of houses put together in a big circle. And this is a solved problem. People have done this materially in the real world. And this kind of comes back to what is NFT debt? Well, it's the first order representation of the underlying asset in a very fungible way. Now, why do we care about secondary markets? Like why do we care about these derivatives? Well, I try to represent it in the best way possible, which is like a box is well organized versus not well organized with a secondary aggregation vehicle. And this is how you move, I guess, the supply chain. If you organize it really well, entire economies can be built. Whereas if it's not organized, then the depth is usually typically very shallow. And that's what we saw when we first entered this industry, and we'll talk about it in a minute. But people weren't buying secondaries. They didn't know how to price a loan or how to even underwrite a single transaction. Like, what is a CryptoPunk worth? But then how do you underwrite the risk for it? What is the duration? What is the term? It's a lot of boring work. And the way banks work is that they use 23-year-olds to work until 3 a.m., and that's how banks work. And because they underwrite the actual risk every time they can. And whereas if you organized it, price it, and kind of create market depth, well, that's when the economy can actually scale, which Conor will take over from here.
Thank you, sir. Yeah, so just the capital markets side of this. So David was talking a lot about kind of the actual building blocks, and then really what we focus on is taking those building blocks and scaling them the way that it's done in kind of the traditional world. So when we first started looking at this space, really, Niftify was pretty much the only player back when we were looking at it in August of 2021. Peer-to-peer markets are generally quite challenging to scale like kind of the middle of the curve. Really useful for kind of the longer tail of assets. And so there had been about $15 million worth of lending volume done at the time, I think, something like that, $15 billion worth of transaction volume. And we were looking at it and just thought, that there's an opportunity here to come in as sort of a scaled participant. If you think about an individual that's doing an agreement with a borrower and they are putting up their own capital to do a single loan against a single NFT, and they have to go through the labor process of underwriting that asset. They have to understand the risk profile. They have to negotiate with the borrower. And then ultimately, like, that's their own money. So like, what's the cost of capital of you as an individual? Like in crypto, you're looking to get like some huge return. You compare that to like an aggregated participant who's got a much lower cost of capital. And that's really what we wanted to do. And so the first approach to kind of like addressing this problem or opportunity where you saw like really low kind of lending volume relative to like very high asset values was just to be kind of like a scaled participant in the space. So we raised capital, we deployed it on these peer-to-peer lending platforms. And really the whole strategy was, if you guys saw the NFTFi presentation earlier, APRs were, on average 60% or so, even higher than that, like 100, 200% on the smaller assets. And so we basically just said, okay, if you can only do obviously not very much volume when the cost of capital is 60%, just lower that cost of capital until you get to a point where you're actually reaching what we would deem like a market clearing penetration, right? And so it's very simple. I mean, we just literally took capital and every week we would lower our interest rates, and then we would get to a point where we eventually had more demand than we had supply of dollars. And also kind of goes hand in hand with the broader kind of awareness of the space over that kind of six month period or so. David and I have background in kind of like underwriting risk, underwriting credit, but fundamentally, like, debt markets are not super complicated. Generally, the smartest guys in the room are further up the risk spectrum, right? Like, you're taking on very little risk when you're underwriting leverage for, secured loans is like the lowest form of leverage, right? And so, we basically came up with a fairly simple framework that sizes maximum LTVs based on historical price volatilities of assets. Something simple as over a 90-day period, how much does the price move, and therefore historically if it moves up and down 40%, you don't want to have a loan that's 80% LTV, right? In those black swan events, you're going to lose your money. It's very simple, but we kind of deployed this strategy and ended up deploying about $30 million worth of lending volume since August. And some of these charts will look familiar. Jonathan was talking about these earlier, but basically when we entered the market, the interest rates were super high and there was not as much lending volume. And then as we kind of tried to deploy capital and lower those interest rates, you actually saw like net new borrowers enter the space. People who would have before said, I've got these big portfolios of NFTs, and the only thing, the only cost of capital I can get to borrow against them 60%, like, what am I going to do with that money? It's no point in even borrowing. And then as you lower that cost of capital, you start to see people that say, okay, at a 15% APR, 10% APR, 20% APR, like, yeah, that's a cost of capital that I can actually like go out and beat in a DeFi strategy or something like this. And so like this, in the top right-hand corner, that's our kind of penetration to the total lending volume. So started to really ramp up lending volume over the last kind of 6 months or so. Still continuing in this sort of just like pure credit fund strategy where we were basically just deploying capital on these marketplaces. And so what does that end up looking like? We've got all these promissory notes that is minted through these peer-to-peer platforms, through NFTFi, and they sit in our wallet and doesn't do anything. It's this like huge opportunity to realize that this is composable and this is the building block that you build your protocol around. So basically, what we realized was you can take all of these promissory notes, and at any given time during that loan, it has a different value, right? So 30 days in, the present value of, these are balloon payments, so 30 days in, the present value is different than it is 60 days in. And it could also be different if 30 days in, the value of the collateral has changed, right? So let's say I originate a $40,000 loan against a CryptoPunk, and when I originate the loan, it's $100,000 collateral. So it's 40% LTV. So then the value of the collateral skyrockets. So now that's a much lower LTV. That should have a lower interest rate, right? And by having a secondary aggregation vehicle, you can basically real-time price changes in these loans throughout their duration. So basically, like the protocol that we came up with is sort of these continuous time vaults, and those vaults buy these loans on a secondary transaction. And what that does is it takes all those node originators that are going on Niftify and originating a loan with their own money, and it turns them from a bank into like a volume business. So now that person who originated this loan and previously just had to sit on that capital is able to just recycle those proceeds, generate some spread between the sale of their loan and when they originated it based on a change in kind of the risk parameters, and then ultimately like recycle that capital more quickly. And the ability to recycle capital more quickly is ultimately what drives capital efficiency, brings rates down, brings in more borrowers, and just gets penetration rates up to just a normalized level, right? It's sub 1% penetrated right now. And some of these assets are extremely valuable and just sitting on people's books, not doing anything. They don't want to sell them because realized capital gain. So basically, the protocol takes all of these loans and it bifurcates them into different vaults based on kind of the type of asset. So profile pics versus land versus whatever, right? And this whole process can be entirely decentralized because the interest rate is a function of like vault utilization and loan parameters. And just like you see dynamic interest rates in DeFi, you can have dynamic interest rates here too. And then you can get real-time pricing and you just have a much more efficient kind of capital market. Ultimately, what this looks like is this sort of secondary capital vault is implicitly driving interest rates as you go, up the capital stack to the direct origination side of the equation. And so now, like all this capital gets aggregated, and then that capital gets to determine what the interest rates are for the profile pick vault versus the avatar, the land vault, or the play to earn vault. And even within that vault, you have collections that are kind of competing for better interest rates for their specific collection. So even if you financially might not care about the interest rates of like Bored Ape Yacht Club, but you own like CryptoPunks, you can implicitly improve the creditworthiness of your asset, which in turn increases the value and makes you more money, right? All of this is just to say, like, these are concepts that are very common in traditional markets, but just haven't had the opportunity to mature in this space. And by introducing sort of secondary capital market action, you get a lot better capital efficiency, and just you should see like the growth of the kind of NFT financialization really start to boom as people realize like I can actually make money by borrowing against this asset. This is a good thing for me, right? So to just kind of wrap up, I mean, basically, we see the experiment starting as sort of this direct origination fund, and then grows into sort of these permissionless vaults that sit one layer behind direct origination. Ultimately, decentralized and allows for kind of control of interest rates or competition to control for interest rates within the vaults. And then, over the long term, allows for kind of those secondary derivatives to exist. Just like the composability layer of promissory notes allows our product to exist, our product will then allow credit default swaps, interest, insurance funds, back leverage. So like picture like you buy a ERC, or you deposit capital into a vault, you get an ERC 20, that represents your position, your junior or senior position. And you can actually go to like a Rari Fuse pool and like get leverage, back leverage against that. So like you're going to take maybe the portfolio vault is getting a 10% yield, but you're in the kind of junior position, so you're getting a 20% yield, and then you're levering that up 2 or 3 times on top of that. All of that can't exist right now because you don't have sort of that first the second layer on top of these promissory notes. But yeah, that's pretty much it. So yeah, we'll be having some news May 31st next, didn't come out quite well, but next Tuesday. Yeah, feel free to join our Discord and get to know us. Thanks.